Welcome to Second Take, the show that focuses on the issues behind the news. This week, the United Nations Conference on Trade and Development released its 2011 World Investment Report, which makes for some disturbing reading for South Africans. Terence Creamer joins me to explain why. Terence, welcome to Second Take. The figures for South Africa and Africa have been described as depressing. Why is that?
Well, I think for Africa, if we start there, it's depressing because while the rest of the world has gone up in terms of foreign direct investment flows, and that's mostly out of Asia and Latin America, Africa actually declined last year in 2010. In fact, it declined by 8.5% to 55 billion. So it sort of bucked what was a good trend for the developing economies. In fact, developing and transitional economies now make up more than 50% of FDI flows in the world. So you can see this big shift. Tectonic plates are moving and from west to east and also from north to south. And it's really reflected in this report how the shift is happening, and it's a decisive shift. And I think we're going to see that trend continuing. But Africa didn't really keep pace. Angola remained Africa's largest recipient of FDI with $9.9 billion. But that's quite well down on what it was receiving a few years ago. I think it peaked at around nearly 17 billion a few years ago. And then for South Africa, the reading is much more depressing because we've fallen from around 4th spot in Africa to 10th spot. We only attracted $1.6 billion last year of foreign direct investment, a year that we saw the World Cup happening and there was much euphoria around South Africa. And this is quite well off both the year before when we attracted 5.4 billion and our peak of around 9 billion in 2008. And that was linked primarily to the RCBC deal when they entered into Standard Bank. So you can see it's quite a big drop, 70% drop. And therefore for South Africans, it's fairly depressing. And in light of what's happening in the country around foreign direct investment and the debates around Walmart, I think it's grist to that mill in terms of saying, we really aren't doing our bit to attract foreign direct investment.
How much weight should we give these figures, and what should it signal to policymakers and politicians?
Well, I think the first thing we realize is we have to give a weight to what I said, the big shift that's happening in the world. Of the $1.24 trillion of FDI that flowed last year, that's 5% up on the year before. So you can see a recovery from the global financial crisis, still well below the peak, but we're heading toward the United Nations Conference on Trade and Development believe we're heading back towards pre-crisis FDI flows, although we've hit a fairly soft patch in the global economy, so people are not 100% sure. I think the feeling is that FDI is important. It brings a bundle of resources to the South African economy and to African economies generally. So I think that we should give credence to it. We should look at the top line figures, but the top line figures aren't the most important, especially in South Africa's case, because as I said, one big deal changes the picture dramatically, like we saw with the RCBC deal in 2008, and what we're going to see with the 2011 figures is a massive spike up from this very low base. When we see the Walmart figures coming, that's 2.4 billion on its own. So we have to realize that South Africa, unlike a lot of other countries that attract greenfield FDI, which is really what we need to gather and build momentum around in South Africa, our FDI flows are generally related to our large stock exchange listed companies, merger and acquisition activity. And that's why they can be very lumpy. So we have to take this seriously, but also with a sense of perspective that it's not the end of the world. We should rather be looking at the quality of these FDI flows as well, and whether they're going into building new factories and new industries. And that, I'm afraid, I feel that these figures reflect that we really are not attracting that sort of FDI into the country at the moment.
The report talks about non-equity foreign direct investment. What is this?
Yeah, this non-equity modes, it's a new term, but if you think about it rather in terms of contract manufacturing, contract mining, services outsourcing, franchising and the like. And they're saying, this is a whole different form of foreign direct investment, and it comes in a different different formation to what we used to, where it's a merger and acquisition activity, or whether it's a greenfield projects. These are sort of relationships in the value chain, and a lot of the large economies, especially China, but also other large emerging markets, are really tapping into these non-equity modes of production and foreign direct investment, and looking at how they can add value to or create jobs, create growth, and also be part of these global production chains, tapping into these large global systems, because these transnational corporations are significant investors and are significant players in the global economy. So to tap into that, there is a potential to leverage jobs and growth, and we've seen it with companies such as Foxconn in China. We've seen it in the garment industry in Lesotho, how they've tapped into those supply chains. South Africa, I think we've only got there's only 2 enterprises listed in the many enterprises listed in terms of tapping into these non-equity modes, and they're both in the automotive milieu. So I think what this report is saying, yes, often these non-equity modes are seen as sort of second-class FDI, but you must realize it was $2 trillion worth of sales last year, so it's not a small fry at all. And yes, there is concern about the nature of the jobs created, the vulnerability to business cycles. So if a business cycle turns down, you do see jobs pulled back. And also, there's often these exposés around these garment factories and these electronics factories, and showing that it's sweatshop type labour and the conditions aren't good. So there are those downsides to that. But on the other hand, the report makes a case for the developmental impact of these sort of modes. And I think our policy and our policies generally around New Growth Path and Industrial Policy Action Plan, they sort of play some lip service to this, but I don't think we've really got our mind around what this means. I think you have to have your whole local enterprise development strategy built in a way that you can allow these multinationals to speak at a certain level with local enterprises. So they have to be of a certain scale to really register on a multinational's radar. So I think we do have to give some thought to this. Do we want to play in this game? It seems to be a very fast-growing area. It seems to be job-rich. Those are two things that South Africa is lacking: growth and jobs. So I think it's something that we should take seriously. And it comes back to the whole Walmart saga. Should we really be attacking the economist that presented the report in South Africa, Stephen Gelb, actually raised the question: should we really attacking the deal from a competition policy perspective, which is where our ministers have chosen to attack the deal from? Or shouldn't we really be trying to engage with these multinationals on this non-equity mode type thing? So the 100 million rand fund that Walmart has set up to develop suppliers, shouldn't we really be interrogating that, working with that, trying to scale it up, and trying to do beyond the hake that's going to go into certain supermarkets in the rest of the world, looking at getting in South African products into the Walmart system? So he's saying maybe it needs to happen at a different level. It's not competition. The competition policy sort of entry point is not the correct one. And I actually think I tend to agree with that.
Terence, thank you very much. That is the Second Take show for this week. Thank you for watching, and join us again next time for more news analysis.